Hi, everyone. Welcome to Chapter 6, which is about a firm's production decisions and their costs in the short run. So in this segment, we're going to talk about different types of firms briefly, and then introduce specifically what production is and how costs arise very briefly again. And then we're going to focus mainly on explicit and implicit costs and how you measure accounting profit and how you might measure economic profit. So let's take a look at the various types of firms again, very briefly. First of all, we have a sole proprietorship. That's probably the most common type of firm that we might find out there. And the owner or manager is responsible for all activities of the firm. It's a heavy load. They often do the accounting, run the firm, do the actual work themselves. But the big problem here is that there's a huge risk on a sole proprietor. They are actually personally responsible for all debts and any damage that the firm or company might cause in its day-to-day operations. So the second type of firm we have is called a partnership. And it's where two or more joint owners run a particular little company. And it's like a sole proprietorship, but different in the sense that there's two people or more people that are involved in it. So the access to money is a little bit easier. The access to bank is a little bit easier. But you have to also be careful with the partnership because although some of the partners have a limited liability and no part in running the company, others do have liability and are actively involved in running the company, so they too can be responsible for debts and legal ramifications of operating that business on a day-to-day sense. So a corporation actually gets around those things. A corporation, that's the owners, usually stockholders. They're not personally responsible for debts, and they're not usually personally responsible or involved in the operations. It's actually a separate legal entity, a corporation is. So corporations can break laws, they can be sued, they can sue others, and the owners are not actually financially responsible for anything that goes on. Now that changes sometimes where we have a board of directors and CEOs of companies that if they make certain decisions, they can be held liable, but it's usually, involves legal action through a court of law. But a corporation of itself doesn't have to be big. I had a corporation and I was one person in the company. I hired one other person, but I was a corporation, a legal corporation. And it takes money to start a legal corporation, but not that much because I was able to do it. Another type of company is a state-owned enterprise. That's generally run and owned by the government. And the people that do run it are generally appointed. In Canada, it's called a crown corporation. We've had crown corporations through the past. Canada Post is a crown corporation. Petro-Canada used to be a crown corporation until it became private. And the last type of firm we talk about is a nonprofit organization. They basically are focused to achieve certain goals and provide certain goods and services, but their main intention is not to make a big profit. Now you have to keep in mind that they still have to make some profit, or they still certainly have to account for their funds, or there are issues that will arise there too. Okay, let's take a quick look at, in a real simple sense, what we mean by production and what we mean by costs. So the activity of a business takes all the resources that are available. Remember, land, labor, capital, entrepreneurial spirit, and it combines them. So we call those resources inputs, as it shows on the slide. So example of making concrete. The inputs are sand, gravel, cement, water, machines, labor. All of those are inputs, and they can fall into the broad categories of land, labor, capital, enterprise. And then we have a production process, or we defined it earlier as a technology, a technological process to combine all these inputs, and we get outputs. In this case, it's concrete. So inputs and outputs, understand the difference. Costs is generally a term used for the inputs, and for outputs, you think of the term price, because that's what you sell the outputs are at. So costs are really the payment for those inputs, and that's where we get the term costs of production. In this chapter, we're going to go through and in the short run, look at different categories of the costs of production and look at decisions that businesses might make based on the costs of production. So the very first thing we're going to look at here before we go too far is explaining the difference between explicit costs and implicit costs. And then we're going to do an example. So explicit costs and implicit costs, they kind of get at the way accountants versus economists might look at profits. But first, let's look at the costs. An explicit cost is a cost that's actually paid out in money. So when you purchase sand and gravel and labor to make concrete in the previous example, you pay money out for these things. If you need any tools or other materials, you actually physically pay money out in dollars. And that's what we term as an explicit cost. It's the most common type of cost. But we also have something called implicit cost. And we're getting at opportunity costs here. It is a cost that we account for, but it doesn't require an actual expenditure of money. Like, what the heck does that mean if we're not actually paying out any money? And it's like if you have your own business and at night you sit down, as my dad used to do on a small business he had, and he'd spend his time issuing bills to his customers, he'd do bookkeeping, but he wouldn't pay himself a salary to do that. So he's giving up his own time. So an implicit cost is the value of the company owner's time and also the value of any financial investment that they put in the company that could be earning them something or earning them a return if it were put to another use. So let's take a look at that in a little more detail. Here's a profit and loss statement for a company, and I think in the text it's called Otto's Tote Bags. So we're looking at Otto's Tote Bags, and I believe it was Otto and Melissa basically decided to give a little bit of their cash and put it in a business and give up a job that they had, part-time jobs, to start this tote bag business. So it doesn't really matter what the period is at this point. Let's say maybe it was a year, or let's just say it was a month. The total revenue, the cash sales they made in that month came to $20,000. Okay. The explicit costs that they incurred that month doing their business right here, the explicit costs include these various things: rent for $1,500, materials and supplies. Those are those input things like buttons and leather and thread and sewing things of $4,200, and utilities. Utilities are, say, gas and electric that they had to pay this month to run their little business, and they hired some labor. So they've got $10,000 spent on labor. And of course, they depreciate the equipment that they had purchased. So if you add all those up, those are all explicit costs where there's actual cash paid out. It comes to $17,200. You subtract that from the revenue or the sales that they did, and you end up with an accounting profit of $2,800. Now, I want to imply that for sure this is the accounting profit, but not the economic profit. To get at the economic profit, we look at something a little more. You want to say, are they as good off or as well off as they could be, or as well off as they were before they quit their jobs and invested their personal investment into this company? So for that, we look at implicit costs. We have to further deduct implicit costs. Well, we're going to say they had $96,000 that they ended up putting into the business. That was their own hard-earned cash that was earning $800 outside the business. So they gave up this earning of $800 outside the business to start their business. They didn't technically give up the $96,000. That's still there. It's in their business, but they're giving up earning $800 a month on it. That's an opportunity cost of their financial investment. That's an implicit cost. They also gave up a couple of part-time jobs. So the labor that they used to put in and make in their part-time jobs was $4,000 a month. Now they're putting labor into their company, but they're not paying themselves a salary. So they gave up $4,000 a month to do this business. When you add up those total implicit costs, they come to a further $4,800 of costs we should include. So we subtract that. Let's add up 17,248, and that gives us 22,000 of explicit and implicit costs, adding them both together. And so therefore, in the end, we see we've got an economic loss of $2,000. Now, that doesn't mean that the bank says, hey, wait a sec, you lost $2,000 this month. In fact, the bank looks at the accounting profit up here and says, yeah, we're happy. You've got $2,800 that you made. The accountant says, yeah, you made $2,800. You're doing good. But when they consider what they gave up to start this business, they may want to scratch their heads and think a little, because really they're $2,000 worse off than had they just kept letting their money in the bank earn interest and kept working their part-time job. So the economic cost and the economic profit, or in this case loss, tells you, are you better off with this new business you started, or maybe you should just go back to doing what you were doing before and not making this $2,000 economic loss. So let's formalize the formulas for calculating this. Here's accounting profit, and all we did for accounting profit is we just took total revenue and subtract total explicit costs. So keep that in mind. That's what you'd normally do. That's what an accountant would normally do. That's what the bank looks at. Those are the real dollars that you've calculated and figured out whether you're making a profit or loss. But the economic profit takes the same total revenue, but then we subtract explicit costs, and then you also subtract implicit costs. That's how you get at the economic profit. I like to use the formula here. Economic profit, notice the symbols I'm using, is total revenue minus the explicit costs. So we'll just put explicit costs here. That gives us our accounting profit. But then we further subtract the implicit costs to get at our economic profit. So make sure you understand those concepts, and you can do it pretty much two different ways, however it works best for you. So let's look at a diagram of that. The only thing that changed in this diagram is that now the total revenue is a little bit more than was in our previous number. Our total revenue now overall is 25,000 in sales. So the accountant would take a look at this and go, okay, let's figure out what's going on. So they'd have 25,000 in sales here. And they'd subtract their explicit costs. So they'd add up the rent, they'd add up the salaries, they'd add up all those ingredients or inputs into the production process. And that was the 17,200. So they'd take their total sales, subtract explicit costs or total revenue. Let's just put that here, be consistent, TR minus explicit costs to give them their accounting profit of 7,800. Perfect. That's what you'd show in the bank. Now the economist comes along and says, hold on a sec. Looks like your $7,800 is better off, but what did you give up to start this business? So the accountants come in, the economists come in and look at the same explicit costs of 17,002, but then they say, remember, you gave up $800 interest on that investment you had outside this business, and you put that money in this business, so you gave up $800 interest, but you also gave up your part-time jobs, and together that was $4,000. So you gave up $4,800 implicit costs per month to start this job. Economists call that normal profit. It's the amount of profit that you need to kind of break even to where you were prior to starting up this business, what your old situation was. So when we take out that normal profit or the implicit costs, we end up with 3,000 only of economic profit. Still, that's great. 3,000 of economic profit means you're $3,000 better off than you were before you started this business, even after taking into account what you gave up as far as your personal wages before and as far as your interest on your personal investment before. So on the right side, the accountant's view say, hey, you're making $7,800 cash profit on this new venture. And the economists say, yep, for sure. But let's take a look at what you gave up and the opportunity cost. And you gave up $4,800 to do this. So we're saying you make $3,000 economic profit. Okay, so let's just kind of review those definitions a little bit. We said normal profit. Well, that's the implicit costs. The normal profit is the minimum profit that has to be covered or has to be earned to keep the entrepreneur in that type of business. So basically what we're saying is if I'm not making normal profit, if I'm not even covering that, then maybe I should just shut this little business and go back to the way things were, go back to my old job and put my investment back in the bank if I'm not making this normal profit. So think of it as the opportunity cost, think of it as the implicit costs, but economists call it a normal profit because it's the minimum that must be earned to keep the entrepreneur in that type of business. And then the economic profit is the revenue over and above all the costs, including normal profits. And that confuses you at first because that is the implicit cost, those normal profits. So the revenue above all costs, explicit costs, and implicit costs. That's the economic profit. Now we throw in something extra just to keep in mind. We don't look at it in too much detail, but there's a thing called a sunk cost. And that's, as it says, it's historical costs of an asset that you bought that are basically unrecoverable. So they're not really involved in any kind of business decision once they become sunk costs. And it's kind of like if you hired someone to do consulting research on the market area that you were interested in pursuing last year, and they gave you this big document, 500-page document explaining how you should run your business, how you should market your product. Well, you can't really turn around and sell that next year, right? It's a sunk cost. You hired this economic research. It was useful at the time, but it doesn't have any value anymore as the years go by. Or my buddy used to buy several very specific ovens so he could bake buns for a large franchise that was Canadian wide, but he covered the whole Edmonton area. After a while, the franchise just decided to get their own bakers and produce it nationally and just ship it every day. So he pretty much was out of that business after that. He did other things, but he was out of that specific business. And all those ovens that he bought were just a big sunk cost. They were useless. The company didn't want them and he couldn't sell them anywhere. So a sunk cost is just a side note. Normal profit and economic profit are what you want to take away from this particular slide. So lastly, let's walk through an example. Abdi gave up a job that paid $1,500 a month. So start thinking, gave up a job. Sounds like an opportunity cost to me, an implicit cost. Paid $1,500 a month to open up his own store. He works full-time at the store and doesn't pay himself, which had a total revenue of $105,000 last year. His total explicit costs, and notice they actually give it to us. You don't even have to add them up, are $65,000. He figures his store is now worth $200,000 if he were to turn around and sell it. And you're supposed to start thinking, okay, if he sold it and invested the proceeds, he would make 8% annual return. Okay, what is Abdi's economic profit during the year? So it's this final question that we're trying to figure out. What is Abdi's economic profit during the year? And for that, if we look at the formula, we just need to find total revenue, total explicit costs, and total implicit costs. So the total implicit costs are kind of always the tricky one. So let's take a look at what they do. First of all, what is the total revenue? They give it to us right there. Total revenue is 105,000. Okay, what's my total explicit costs? 65,000. So I know my accounting profit would be 105,000 minus 65,000. So that's relatively straightforward. So let's take a look at that. There's our 105,000 of total revenue that he earns in a year at the store. And there's the total explicit costs. Okay. So I could subtract those and get accounting profit. And the reason I point this out, because I always do it in 2 steps. I always calculate accounting profit, which I would know right now is 105,000 minus 65,000. So you could just work that out. I think it's 40,000, right? That would be accounting profit, but we're not stopping there. They want economic profit. So we go further and subtract the implicit costs. You have to be very careful with this because the wages are 1,500 a month. So you have to multiply by 12 to get the implicit wage cost of 18,000 a year, because this total revenue was 105,000 last year. So be careful when you're doing these, take them all to the same length of time. If it's annual, take it to annual. If it's monthly, take them all to monthly. This case, it's annual. So the annual interest rate was 8%. On the 200,000 that he could have sold his store for. He says his store is worth 200,000. So he could sell it, bank the money, get 8%, and that 8% he's currently giving up because he chooses to keep running the store. He's not selling his store for 200,000, putting in the bank and earning 16,000 a year. So these two are implicit costs. Notice they're a little bit trickier and sneakier to figure out than the explicit cost. So then now we've got all our costs together. We just subtract it. We look at our total revenue of 105,000. Then we add up our total costs, which is 65,000 plus 18,000 plus 16,000. Our total costs are 99,000. And in the end, the total economic profit is 6,000. Now remember, along the way, I calculated, at least mentally, the accounting profit of 40,000. But when you take into the implicit costs, the total economic profit is 6,000. So what does it say? It says he's 6,000 better off than if he had gone back to his old job, sold his store, and put the proceeds and invested it in the bank. He's still 6,000 better off than that previous or alternative scenario, right? The bank says, wow, you're making 40 grand. That's pretty darn good. Keep going. But he wants to go a little bit further and look at what he gave up or what he's giving up to keep the store running. And when he includes those implicit costs, he smiles happily all the way to the bank because now he knows he's making not just accounting profit, but economic profit as well. He's better off in this situation than he was or is in the alternative. So that's it for this segment. We just wanted to carefully explain the difference between explicit and implicit costs and imply that the accountants focus more on the explicit costs because they worried about the dollar value of the numbers, and that's what the bank looks at too. But if you want to completely evaluate a project or your own decisions or your company's decisions, you should include the implicit costs to arrive at economic profit. Are you doing as well as you could in your previous situation, or are you better off? So that'll end that segment. Next, we're going to look at the theory of production, the decisions that producers look at to decide how much they're going to produce. And we'll see you when we get there.